Hi, welcome to this beginner friendly tutorial on credit ratings. Whether you are a student just starting to explore finance or an aspiring investor looking to understand the risks before putting your money into any investment, or you are a professional wanting to add to your financial knowledge, or simply just a curious person who wants to understand how borrowing and lending works in the real business world, then this video is made just for you. Credit ratings might sound complicated or like something only bankers care about, but they affect so many things around us, right from how governments borrow money to how companies grow and how even your investments perform. So, in this session, we will take it slow and steady. We'll start from scratch, we'll build a clear understanding of what credit ratings are, how they work, and why they matter, who gives them, and how they impact everything from big corporations and governments to small investors like you and me. No technical jargon or confusing terms. I will explain every concept step by step and in simple language. By the end of this video or course, you'll be able to confidently talk about credit ratings and know why they are so important in finance. So, all find a comfortable spot, grab a notebook if you want to take notes, and get ready to explore the world of credit ratings in a way that's easy to understand and useful for you. Let us begin. So, in this course, we are going to understand and complete the following. Number one, introduction to credit ratings. Number two, types and scale of credit ratings. Number three, credit ratings, the importance and the methodology in terms of how the credit ratings are constructed or derived. And finally, we will conclude with what are rating upgrades and downgrades. Let's start at the very beginning with a simple question. What exactly is a credit rating? Think about a situation where you want to lend money to a friend. If that friend has always returned your money on time, you probably trust them a lot. But if another friend has a history of borrowing money and then delaying payment or not paying back at all, you will hesitate before lending to them. The basic idea of trust and reliability is exactly what credit ratings represent in the world of finance. So, when someone borrows money, whether it's a company, a government, or a bank, lenders and investors they want to know how likely is this borrower to pay back the money on time. So, a credit rating is essentially a trust score given to these borrowers. It's a professional opinion on their credit worthiness, which means their ability and willingness to repay their debt. Credit ratings help lenders and investors judge the risk involved before giving money. Just like you check someone's record before lending your hard-earned money, large investors they check credit ratings to decide if it is safe to invest or lend. The rating shows if the borrower is financially healthy, stable, and low risk, or if they might struggle and be risky. So, what it means is that if the credit rating is high, it means the borrower is safe, it has a strong record of repaying debts. If the rating is low, it means the borrower might have trouble paying back and poses a higher risk. So, you can think of credit ratings as a financial review or a scorecard. Just like when you buy something online and you check product reviews to make sure it is reliable, investors check credit ratings to decide whether to trust a borrower or not. This system of credit ratings helps reduce uncertainty and makes lending safer and more efficient. So this is what we understood versus high versus low credit ratings. So you see high credit ratings on the left hand side. Why? Because The borrower has a strong repayment record and it's a safe borrower. Low credit ratings on the right hand side, there are potential repayment issues. It's a highly risky borrower. So always we have to compare credit ratings for risk assessment. Now that we know what credit ratings are, let's talk about who actually gives these ratings. Credit ratings are not random guesses or opinions made casually. They come from special companies called credit rating agencies or CRAs for short. These agencies specialize in analyzing the financial health of borrowers. They look carefully at many factors like a company's financial statements, business operations, debts, profits, cash flow, and even the quality of management. After detailed analysis, they assign a credit rating that reflects the borrower's risk level. Worldwide, there are three very big and well known credit rating agencies, as you can see in the slide. Number one is Standard and Poor's, commonly known as S&P. Number two, Moody's Investors Service, and number three, Fitch Ratings. Together, these three control over 90% of the global credit rating market. They have a strong reputation and their ratings are trusted by investors and financial institutions everywhere. In India, we have our own agencies as well. Some of these are linked to these global giants. So number one is CRISIL, mostly owned by Standard and Poor's. Number two is ICRA, associated with Moody's. Number three is Credit Care Ratings. And number four is India Ratings and Research, linked with Fitch. These agencies operate under the regulation of SEBI, which is Securities and Exchange Board of India, which ensures that they work fairly and transparently. When a company or government wants to raise money by issuing bonds or taking loans, they approach these agencies to get a credit rating. This rating then helps investors to decide whether to buy these bonds or not. So, credit rating agencies play a critical role in the financial system by providing objective and professional risk assessments. So, what we have learned so far, what is a credit rating? A credit rating is a trust score that shows how likely a borrower is able to repay debt on time. It helps investors and lenders judge risk before giving money. High rating is equal to low risk, low rating is equal to high risk. It's like checking product reviews before buying, only here it's about borrowing money. Why credit ratings matter? They make lending safer and helps reduce financial uncertainty. They also help in building confidence and trust in the financial markets. Now, who gives these credit ratings? Ratings are issued by specialized companies called credit rating agencies. Top global credit rating agencies are S&P, Moody's and Fitch. Top Indian credit rating agencies are CRISIL, ICRA, CARE and India Ratings. Let's move on to the next section. Now let's understand the types and scale of credit ratings. So this slide breaks down credit ratings into three main categories, reflecting the diverse applications of these assessments. So first is the financial instrument rating. This is perhaps the most commonly discussed type. It focuses the credit worthiness of specific financial products or debt obligations. Underneath this, we have three subcategories. Number one is bond ratings. The bond ratings are crucial for the bond market. A bond rating assesses the likelihood that a bond issuer will make timely interest and principal payments. Higher ratings usually mean lower interest rates for the issuer and lower risk for the investor. Then we have equity ratings. While less common than the bond ratings, equity ratings can assess the financial strength of a company from an equity investor's perspective, though they don't predict the stock market or stock price movements directly. Then we have a short term instrument rating. This deals with financial instruments with maturities typically less than 1 year, like commercial papers or short term notes. These ratings assess the issuer's ability to meet short term obligations. Now, coming on to the main category, number B is the customer rating, which is the middle branch in this slide. This category focuses on the credit worthiness of individual customers or companies. It's often used by banks and financial institutions to assess the risk of lending to a particular client. It's about the general ability of a customer to repay their debts rather than a specific financial product. And then the number C is the borrower rating, which is the right branch here in this slide. Similar to a customer rating, a borrower rating assesses the overall credit worthiness of an entity that is seeking to borrow funds. This could be a corporation, a government, or an individual. It provides an overall view of their capacity and willingness to meet debt obligations. So, one of the most important things to understand is how these ratings are expressed and what the different rating levels mean. So, now let's start with the two most popular agencies, Standard and Poor's S&P and Fitch. They use a similar rating scale that looks exactly like the slide adjacent. So, AAA, this is the best possible rating. It means extremely low risk, the borrower is very strong financially. Double A plus, double A minus, these are still very safe ratings, just a little lower than triple A. A plus, A minus, these indicate low to moderate risk but still considered quite a good quality. Triple B plus, triple B minus, medium risk but still investment worthy. This is where many safe companies fall. Double B plus, double B minus, this is where exactly starts to get risky. These are called below investment grade or speculative ratings. And B plus, B and B minus, they are highly speculative and highly risky. Investors expect higher returns to compensate for the risk. And triple C, double C and C minus, very, very risky and vulnerable to default. And D means default. This means that the borrower has failed to meet its debt obligations. Moody's has a similar but slightly different system using letters and numbers. So AAA equivalent of AAA, then AA1, AA2, AA3 similar to earlier S&P and Fitch, A1, A2, A3 like A plus A, A minus, and so on down the scale. Now here's a very important point, the dividing line between investment grade and junk or high yield bonds. Investment grade ratings of triple B minus or Baa3 in the Moody scale and above are considered safe enough for most investors. These bonds are less likely to default. Junk or high yield ratings below triple B minus are considered risky. These bonds pay higher interest rates to attract investors willing to take a chance. Now, why does this matter? Many mutual funds, pension funds, and large banks are legally required to invest only in investment grade bonds. They avoid high yield bonds or junk bonds because of their higher risk. So, to sum up, higher rating is equal to safer borrower, lower risk, lower interest cost. Lower rating is equal to risky borrower, higher risk, higher interest cost. Knowing the rating scale will help investors decide where to put their money based on how much risk they want to take. Key takeaways so far. So, there are three main types of credit ratings: financial instrument ratings, which rates bonds, equities, and short term instruments like commercial papers, tells us how safe a specific financial product is. Then there is customer rating, which rates individuals or companies. These are used by banks to check if someone is a good borrower for a loan. And then the third one is the borrower rating, rates the overall credit worthiness of a company or a government. Big picture is how well they handle all their debt. Now, understanding the rating scale, top grades are triple A in capital letters or single capital letter A and small AA. These are super safe. Then middle grades are triple B or Baa3. These are medium risk, still investment worthy, and lower grades double B and below. These are high risk or junk bonds. Investment grade ratings are the one triple B minus and above, and junk or high yield ratings are below triple B minus. Why does it matter? It matters because higher rating is equal to lower risk, lower interest. Lower rating is equal to higher risk, higher returns are needed. You might be wondering, why do credit ratings matter so much? Why does everyone talk about them? Let's break it down to see the importance from different perspectives. So for investors want to know how safe or risky an investment is. So credit ratings give them a quick and trusted way to judge that. For example, would you prefer to invest in a government bond rated AAA or in a small company rated double B? Ratings help you choose that. Second is for borrowers, which might be companies or governments. So a good credit rating means that the borrower can borrow money at a lower interest rates. So this saves them a lot of money on interest payments. But if their rating falls, borrowing becomes more expensive because lenders want compensation for taking that extra risk. And third, for banks and mutual funds, these financial institutions use credit ratings to decide what securities to buy. And here we are talking about fixed income funds primarily, who invest in debt securities. So many banks have rules preventing them from investing in low rated bonds because of regulatory and risk concerns, right? So for the overall economy, a country's credit rating affects how attractive it is for foreign investors. So higher sovereign rating, which means rating of a country, means more international investors will put money into that country, helping the economy grow. Conversely, a downgrade can scare away investors and increase borrowing cost for the government. So, credit ratings are vital for the smooth functioning of financial markets. They create a system of trust, transparency, and efficiency in lending and investing. Without the credit ratings, investors would find it much harder to assess the risk, and lending might become costlier and less accessible. Now, let's dig deeper and see how credit rating agencies actually decide these ratings. Assigning a credit rating is a complex process. It is not based on guesswork. It is based on detailed financial and qualitative analysis. So, here are the main factors which the rating agencies look at. Number one, financial strength. They examine revenue, they examine profit margins, operating income, debt levels, interest coverage, and cash flow. So, if a company earns stable profits and generates enough cash to pay its debt comfortably, it gets a better rating. Business model. Is the company's business stable or risky? A company operating in a mature, stable industry like utilities is safer than a startup in a volatile industry like technology. Then there is management quality. Rating agencies, they interview company leaders to assess their track record and integrity. Good leadership and management is crucial for long term success. Then there is market position. Is the company a leader in its sector or it is struggling against its competitors? Strong market leaders generally have a better ratings. Rating agencies also consider macroeconomic factors like inflation, interest rates, currency stability, as these impact repayment ability. Rating agencies also look at industry risks. So different industries they carry different risks. For example, real estate and construction can be cyclical and risky, while FMCG tends to be more stable. So, what does the process involve? The process involves detailed financial analysis of balance sheets, income statement, and cash flow statements. It involves interviews with the company management. It involves review of business strategy and market conditions, comparing the company's financial and operating metrics against the industry's peers, assigning a rating outlook indicating potential future changes also. Now, this rigorous approach ensures that ratings are well grounded in facts and expert judgment. Let's now talk about the important process behind how rating agencies systematically analyze borrowers. This is called credit rating methodologies. A methodology is like a detailed recipe or a framework that rating agencies follow to make sure the ratings are consistent, transparent, and reliable. Without the clear methodology, ratings would be random or subjective. Now, different types of borrowers require different methodologies. For example, the way a sovereign government is rated differs from how a company or a corporate or a bank is rated. So let's see what are the key steps involved in the rating methodologies. So the first step is data collection. The agency collects extensive data on the borrower's financial statements, debt obligations, cash flows, business environment, and the market position. Then it does is what is called financial ratio analysis. They compute key financial ratios like debt to equity, interest coverage, cash flow adequacy, profitability margins, and liquidity ratios. These ratios help quantify the borrower's financial health. Then, what the rating agencies do is called as qualitative assessment. So, beyond numbers, these agencies assess management quality, governance practices, competitive advantages, industry outlook. For example, a company with a strong management team in a stable industry will score higher. Then, what the rating agencies do is called as risk identification. The methodology explicitly identifies and weighs various risks like business risk, financial risk, liquidity risk, macroeconomic risks, etc. Then the rating committee review is done. After detailed analysis, the rating analysts present their findings in the form of a credit report to a rating committee. This committee debates the rating and approves the final credit rating, ensuring quality control and consensus. Rating agencies also do monitoring and updates. They continuously monitor borrower performance and update ratings as new information or market conditions change. Now these agencies they publish detailed methodology documents on their websites explaining how they analyze different sectors. For example, manufacturing, financial, infrastructure, sovereign, etc. A Moody's methodology, for example, places a strong cash focus on cash flow sustainability, while S&P approach might emphasize industry position more heavily. So the methodology might marginally change from one agency to another agency, but the methodology is a public document and anyone can go and download these documents from the rating agency's website. Understanding these methodologies helps investors trust that ratings are based on objective, repeatable processes and not opinions and expert judgment. So, homework for you all. Go to any rating agency website and download any sector methodology report from that website and go through that methodology report. In that methodology report, you can try to understand what are the key focus areas of ratings from that sector perspective. And you can also compare one rating agency report, methodology report, with another rating agency's methodology report to identify the difference in weightages given to specific metrics by these rating agencies. All the best. Now we move on to the next chapter, the corporate ratings criteria framework. So this diagram shows the systematic process rating agencies use to arrive at an issuer credit rating, which is a crucial assessment of company's ability to repay its debts. So the core foundation is primarily that the process starts with two fundamental assessments on the left. You see that there is this business risk profile and market risk profile. These are the bedrock of the rating. The business risk profile on the left side, this looks at the company's operating environment. So factors like country risk, example political stability, or industry risk, example cyclicality of airlines, etc., and competitive position, example market share, etc., determines how stable and predictable the company's earnings are. So financial risk profile. So this assesses the company's financial structure, specifically its cash flow and leverage, in terms of how much debt the company has. So can the company's operating cash flow easily cover its debt payments? Yes or no? A highly indebted company, even if growing, will have a higher financial risk. So these two profiles combine to give us our initial assessment, the anchor. And now modifiers come in where we refine the rating. So next we move to the modifiers in the center. These are crucial factors that fine tune the anchor based on the qualitative judgment. So things like diversification, does the company have a diverse revenue stream or is it reliant on just one product? For example, a conglomerate is generally less risky than a single product firm. Then there is capital structure. So beyond debt levels, how complex or stable is its overall capital? Is debt concentrated in the short term or not? Things like that. And then we have financial policy of the company. Is the management aggressive or conservative with debt or acquisitions? We also look at liquidity. Does the company have enough immediate cash to meet its short term obligations even if it is profitable? Then the rating agencies also looks at things like management and governance. The quality, experience and ethics of the leadership team is very paramount. Strong governance, they instill confidence. And finally, the rating agencies compares the company to others with similar ratings to ensure consistency. After applying these modifiers, we get the standalone credit profile, which means the rating if the company operated completely on its own. But it's not the end. Then comes group or government influence. If the company is a part of a larger or a stronger corporate group, then its rating might be uplifted. Conversely, a state owned enterprise rating might be capped or directly influenced by its government rating, reflecting the implicit support of or control from the government side. So all these steps now finally lead to the final issuer credit rating. This is the ultimate opinion on the entity's creditworthiness, helping investors and lenders understand this risk. So this section, students and professionals, is very critical of the corporate credit criteria framework. Very, very important. And please go through it once again if you want to understand it more deeply. A lot of people confuse credit ratings with credit scores. So, in this section, let me clear this up. Credit rating refers to the risk evaluation of large borrowers like companies, governments, or financial institutions. It mainly relates to bonds and big loans. On the contrary, credit score applies to individuals like you and me. It shows how likely a person is to repay their personal debts, such as credit card loans, personal loans, or home loans. For example, in India, your personal credit score is called as CIBIL score and it ranges from 300 to 900. A score above 750 is considered good. So, this helps banks decide if they should approve your loan and at what interest rate. So, credit ratings and credit scores they serve similar purposes. They assess credit risk but at different levels. Ratings is equal to institutional borrowers and markets. Scores is more equivalent for individual borrowers. So don't confuse them. They are different tools for different audiences. So let's summarize the key takeaways of this section. So why are credit ratings important? They are important for investors. Ratings show risk level of investments. Safer is equal to better rating. For borrowers, companies, or governments, higher rating is equal to lower borrowing cost, which means less interest to pay. For banks and funds, ratings help decide what to invest in safely. For the economy, better sovereign ratings or national ratings is equal to more foreign investments coming in that particular country. So, how are ratings decided? Ratings decided on based on financial strength, which includes profits, cash flows, etc. Business model, stable versus risky business model, management quality, market position, economic and industry conditions. What does the process typically include? It typically includes detailed financial analysis, management interviews, peer comparisons, committee review, remember, and ongoing monitoring. Very, very important. It just does not end when the ratings is assigned. And what are rating methodologies? Rating methodologies are step by step framework used by rating agencies to keep ratings fair, consistent, and transparent. What it includes data collection, financial ratio analysis, qualitative checks, risk weighing, committee approval, regular updates. What's the difference between credit rating and credit score? Credit rating equal for companies and governments, which is at a bond level, and credit scores are for people like you and me, for individuals, loans, personal loans, home loans, credit card approvals, etc. Now, just like people's reputations can improve or decline, credit ratings can also change from time to time. Okay? If a company improves its financial health, increases profits, reduces debt, or grows in a positive market, it can receive a rating upgrade. On the other hand, if a company's financial condition or performance worsens due to missed interest payments or falling sales or rising debt levels, it might get a downgrade. Agencies also assign a rating outlook with the rating. Very, very important. So, positive outlook means an upgrade might happen sometime soon. Stable outlook means that no immediate change is expected, while negative outlook signals a possible downgrade. Now, why do upgrades and downgrades matter so much? A downgrade usually increases borrowing cost and reduces the investor confidence. Stock prices may fall and it becomes harder to raise money. An upgrade improves the reputation, reduces the interest cost, and attracts more investors. Investors closely watch rating agencies because they affect risks and returns. Now, in this section, let's look at some real world examples to make the concepts we have studied so far clearer. So, India's sovereign rating. So, India's rating by Moody's is currently Baa3, which is investment grade but on the lower side. If India's rating improves, it will attract more foreign investments into government bonds and Indian companies. An improvement signals economic stability and a stronger growth prospects for the country. Right? Now let's look at few corporate examples. So in 2019, Yes Bank was downgraded due to rising bad loans and financial troubles. Now, this downgrade caused panic among investors, the share prices plunged, and depositors worried about their money. This example shows how a rating downgrade can have real effects on a company's market value and trust. And now let's talk a little bit about mutual funds and ratings. So, debt mutual funds, they invest in bonds with various ratings. If a bond in their portfolio is downgraded, the fund's value may drop, hurting the investors. So in 2020, Franklin Templeton's debt funds faced trouble when some bonds were downgraded, leading to huge redemptions. And now let's talk a little bit about the investor portfolios. So, savvy investors, they use a credit rating matrix to balance risk and return. What they do is they invest in a mix of AAA, AA, and some triple B bonds to ensure safety while getting reasonable yields. So, what that means is that investing in different categories or different ratings of debt instruments from the highest rated to lower rated, this strategy reduces the chance of losses due to defaults and making sure that the fund still is able to manage a good yield out of its entire portfolio. Now, let's quickly review everything we have learned today. So, credit rating is an expert opinion on whether a borrower, company, bank, or government can repay its debt, right? Ratings help investors, banks, mutual funds, and governments make smart decisions. Ratings are assigned by rating agencies like S&P, Moody's, Fitch, and in India by CRISIL, ICRA, and others. The rating scale ranges from AAA, which is the best one, to D, which is a default one. Rating agencies above triple B minus are called investment grade, while those below triple B minus are called junk or high yield. What is India's rating right now is triple B minus, just on the lower side of the investment grade. Higher ratings mean lower risk and borrowing cost, lower ratings mean higher risk and interest cost. Ratings can go up or down depending on the borrower's financial health. They are not absolute truths but informed opinions based on detailed analysis. So, this is the final summary of this credit ratings tutorial. The, the objective has been to keep it simple so that you understand the concept of credit ratings and are able to navigate it and apply it in the world of finance. I hope this tutorial has helped you understand credit ratings clearly and confidently. Thank you so much for watching this tutorial and wish you all the best.